Have you ever thought about investing in index funds for long-term growth? Index funds, gaining popularity among investors of all levels, are a unique type of mutual fund. To keep it simple, imagine a portfolio designed to trace or mirror a market index's components. Let's say an S&P 500 index fund. Its purpose would be to replicate the performance of the S&P 500 index. This investment tool's essence lies in its ability to offer broad market exposure, maintain low operating costs, and ensure a low portfolio turnover. The key point here is that index funds aim to be in sync with the market, not to surpass it. They have an inherent capacity to evolve alongside the market, making them a potent, sustainable instrument for growth in long run. Hence, if the notion of index funds piques your interest, stay tuned. We're poised to explore the intricate workings of investing in these funds and the potential rewards that await those who dare to venture. So, if you're intrigued by the idea of index, keep watching. We're about to delve deep into the process of investing in them. To start, it's crucial to understand what an index fund is. An index fund is a type of mutual fund or exchange-traded fund designed to mirror a specific market index. It's not actively managed like other funds. An index serves as a stock market yardstick. Renowned indices include S&P 500 and the Dow Jones Industrial Average, tracking the performance of major U.S. companies. When you invest in an index fund, you're essentially investing in the market index it represents. The of your investment correlates with the index. If the index rises, so does your investment. If it dips, your investment decreases likewise. An index fund offers a way to invest in the entire market or a market segment, rather than selecting individual stocks or bonds. This investing style introduces the concept of passive investing. As index funds follow a market index, they're seen as an investment form. There's no fund manager making buy or sell decisions. The fund merely retains all securities in its tract. This passive strategy often leads to lower fees and less trading, potentially reducing taxable events for investors. Diversification is a critical advantage of index funds. Investment in an index fund means investing in numerous companies or bonds simultaneously. This variety helps to lower risk. If one company underperforms, the other's performance balances it out. This balance can provide some protection against market volatility. Now that you know what an index fund is and its benefits, you're probably wondering how to invest in one. But it's essential to remember that investing carries inherent risks. Like all investments, in-depth research, careful consideration of your financial goals, and risk tolerance are vital. Stay tuned as we delve deeper into the process of investing in index funds. Investing in index funds is not as complicated as it may seem. To understand this better, let's begin by breaking down the entire process. The first step involves choosing the right brokerage. This platform is crucial as it enables you to buy and sell securities like stocks and index funds. While selecting a brokerage, it's vital to consider several factors. Account fees, trading charges, and the user-friendliness of platform are just a few. Once you make your choice, the next stage involves picking an appropriate index fund. An index fund is essentially a type of mutual fund or an exchange-traded fund, ETF, that possesses a portfolio constructed in line with a financial market index. The world of investing is teeming with a variety of index funds, each of which tracks distinctive markets and sectors. Opting for the most suitable index fund will depend on several personal factors. Your financial aspirations, risk-taking capacity, and investment timeline rank high among these. For example, if you're inclined towards long-term growth and can brave some degree of volatility, you might choose an index fund that follows a broad market index like the S&P 500. Conversely, if you're approaching retirement and require more safety, an index fund that tracks a bond index could be your go-to option. It's essential to keep in mind that investing doesn't follow a one-size-fits-all rule. So take your time to explore and pick an index fund that aligns seamlessly with your unique needs and objectives. After selecting an index fund, it's time to make the investment. This simply means buying shares of the index fund through your chosen brokerage. The number of shares you decide to buy will be contingent on the amount you're capable and willing to invest. Remember that investing in index funds is typically a strategy for the long haul. This implies that you should be ready to keep your money in the fund for a minimum of 5 years, and ideally, much longer. It's also advisable to regularly augment your investment over time. This technique, known as dollar cost averaging, can prove beneficial. By diligently following these steps, you're preparing yourself to become a seasoned index fund investor. It's crucial to remember, Investing is a journey, not a sprint, so take your time, do your research, and make informed decisions. Investing in index funds for long-term growth has its unique advantages. To commence, let's tackle the advantage of diversification. Index funds, mirroring the performance of a specific index such as the S&P 500, provide a broad market cross-section for investment. This diversification mitigates the risk associated with individual stocks. In essence, you're not placing all your bet on one opportunity. Then, we turn our attention to the advantage of lower costs. Index funds, being passively managed, strive to echo the performance of their index, as opposed to outperforming it. This results in lower expense ratios compared to actively managed funds, ensuring more of your investment stays put and grows over time. A slight difference in fees can have a notable impact on your long-term investment. The long-term growth potential of index funds is another key point to consider. Historically, the stock market has shown an upward trend over extended periods. There have been downturns, but overall, the trajectory has been ascending. Consequently, index funds, as a market reflection, also manifest this upward potential. It's important to remember that past performance doesn't guarantee future results, but the long-term market growth trend bodes well for index fund investors. Finally, passively managed index funds offer a set-it-and-forget-it convenience. This enables you to circumvent the stress and time investment of constant monitoring and adjustments. Instead, your money can be put to work, potentially augmenting your wealth over time. A critical point to remember is that every investment involves some degree of risk, and it's recommended to consult with a financial advisor before making decisions. So, with these points in mind, let's see why index funds are a good choice for long-term growth. Index funds are a formidable tool for long-term growth. You might be thinking, what makes these funds a growth catalyst? The answer resides in a concept we refer to as compound interest. This concept, hailed as the eighth wonder of the world by Albert Einstein, is a process through which your earnings yield additional earnings. Your initial investments, coupled with any interest, dividends, and capital gains that accrue, aid in generating more interest. As a result, your capital swells over time, and the pace of this growth accelerates the longer your money is invested. It resembles a snowball, expanding and accelerating as it descends down a slope. Moving on, examining the historical performance of index funds is worthwhile. Over prolonged periods, index funds have proven to consistently provide robust returns. For instance, the S&P 500 index, a renowned benchmark for U.S. equities, has recorded an annualized return of approximately 10% over the past 9 decades. Such a return is highly rewarding. But how does this translate to your long-term financial objectives, such as retirement planning? By systematically investing in index funds, you are essentially purchasing a minute portion of the entire market. This wide-ranging diversification aids in diluting risk, and the low costs associated with index funds ensure that a larger portion of your money is employed for you. Over time, this strategy can accumulate sizable wealth for your retirement. However, it's crucial to remember that historical performance does not assure future outcomes. The market is subject to volatility. However, maintaining a long-term investment strategy and avoiding impulsive reactions to market fluctuations increase the probability of your investments appreciating over. As demonstrated, investing in index funds for long-term growth can be a wise decision. But like all investments, it's important to do your research and consider your financial goals and risk tolerance. So, are you ready to start your journey with index funds? Today, we've delved into the nuances of index funds and their potential for long-term growth. We've discovered they offer diversification, transparency, and a high degree of exposure to various sectors. These funds follow specific indexes, allowing you to tap into the performance of the entire market, not just individual stocks. It's not a get-rich-quick scheme, but a strategy for gradually building. In index funds is about consistency and patience and cultivating a clear vision for the future. It's about embarking on a journey where your money works for you, steadily growing and compounding over time. This path leads to a future of financial security and freedom. Remember, the journey of 1,000 miles begins with a single step. Start investing today for a better tomorrow. Don't forget to subscribe to our channel to learn more about financial strategies and click the bell icon to be notified when a new video has been uploaded.